I own it. I love it. Not only is it an iconic brand, it's proven the innovation behind the product and certainly the wow factor, I think. I think the investments that they've made into logistics and ERP, but obviously the DTC business is, the target is 50%. John Donahoe, I think, is the guy that's leading that efficiency, even though, again, we talk about a company that I think is out there on the consumer side and continues to have U.S. comps and North America that are blowing away and at least giving you a little relief around some concerns around Asia. The problem is valuation. And I think if you look at Guggenheim's upgrade, stock's still at 35 times 23, but it deserves a premium, and I stay there. I love it.
Nancy, what do you think about Nike?
So I think Nike's done a lot of things right. I agree with Tim. They get about 18.5% of their sales from China, and they've been able to thread that needle very nicely as opposed to some other retailers. That said, we don't own it in our Gartby portfolios anymore because of valuation. I love the brand. I own it personally, but I think you have to be sensitive, and I would advise to wait for a pullback. It's at 35, I think, is what Tim said for 23. It's at 44 on 22 earnings, and a yield of 0.75, so you're not getting paid much in terms of yield premium. And so I think there are probably some better places to hang out in the near term.
It's one of those stocks, Dom, that makes you go, yeah, that's why it has a high PE. You know, when it's pretty much a sure thing, you got to pay up for it.
Well, it's not just that. It's the brand cachet. It's been there for such a long time. And it was something that you mentioned that was a highlight in the note that really caught my attention. It is the metaverse, because after reading the note, I thought about it. In many of the conversations that I've had with investors, traders up and down Wall Street, when we talk about the metaverse, either in an optimistic or critical way, the one brand that comes up more often than not with regard to who could benefit as a consumer brand from a metaverse play that could be big in the future happens to be Nike. It gets mentioned a lot. So when we talk about the future for Nike, capitalizing on the brand in a world that is like Farmville 2.0 could be something where it could really drive some of that financial performance in the future. But the question, of course, is, to Tim and Nancy's point, the valuations at these levels.
Listen, with Omicron, we're all like looking for a metaverse tomorrow here that we can do a TV show in and all be virtually at least in the same place. It really is accelerating some of these trends. But let's move along and talk about, yes, tech is involved here, but McDonald's is very much kind of an old school call. It's a top pick from Piper Sandler here. The analysts are saying the company's size should help it navigate all the labor and commodity problems. According to their survey, consumers are loving the drive-through, as always. The hamburgers and chicken, all of which McDonald's has a leg up in. Shares were up 25% in 2021, Dom. So kind of a similar story here as to Nike.
So I would say, if you're a viewer out there or a listener to us right now, think about when you drive past any fast food chain. Where I live, out in the New York metro area, what I've tended to see during the course of the virus pandemic, and even as of late, just in the course of the last few months, is a lot of traffic at the drive-through and in the parking lots for kind of like the curbside pickup at places like McDonald's. I have not seen as much of that, as much as we talked about the chicken wars, right, between Popeyes, KFC, Wendy's, and everybody else. I haven't seen as much of that traffic there. McDonald's maybe has a position where they can now say that they've driven a lot of the efficiency into their operation around these pandemic operations. And if that is to stay, that could be a big reason why some traders are getting at least a little bit more optimistic about McDonald's in the coming months.
Tim, you own McDonald's?
I do, and I'm going to make sure I'm not behind Dom on the road because he clearly breaks for McDonald's. And I think you have a case here where the celebrity innovation, the partnerships with Travis Scott, with Saweetie, you name it, is part of the wow factor. McDonald's is cool again. And if relative to their peers, they're even claiming ESG scoring, which is not something we always thought about with McDonald's in terms of the quality of the food. But the food has changed. And I think the other dynamic here is not only are U.S. comps 18 out of the last 20 quarters been outperforming their peer group, but the unit growth on the stores. So there was a time where McDonald's needed to close down stores. They're actually opening up in high growth areas. You're actually going to see this as more of a growth company. So add in loyalty, which helps the valuation, and a stock that did nothing for 18 months started breaking out in October, and I think it's going higher. I am long the name.
I keep trying the chicken nuggets, Nancy, but I still don't. I'll take Wendy's, but I still can't get on board with McDonald's. What do you think of the name?
We own it. It's one of our largest holdings in our equity income strategy. Pricing power, low price point restaurant. And so that appeals to a much broader universe of consumers. But also we're seeing a shift to services spending in 2022. So I think all of that benefits McDonald's. Got a healthy yield. They grow the dividend. As Tim pointed out, comps are outperforming their peers. And I am intrigued by the ESG score because many years ago, they got a much higher rating on treatment of the animals that they purchased than Chipotle did, which is another one of our largest holdings. So I think there's a lot to like about this name as you go forward. But the stock has not outperformed the market for 3 years. It's kind of muddled along with the S&P.
Shepard Smith here. Thanks for watching CNBC on YouTube.